What up, devils? Old Uncle Toot here with another video for you. This is going to be a training video, not an analysis video. So if you want looking for analysis, go ahead and click the next button. But for those of you that want to get some training and be able to follow along with analysis, this video is for you. So this is a very remedial concept that if you even want to have the hope of following along with Sam's videos, you need to understand. But so it's going to be taught to you in the same vein as I'm doing an applied Elliott Wave Theory series for the members. And the whole point of that applied theory series is to show you how to apply this theory to the hard right edge of the chart and make money with it, because that's the only reason that we do Elliot. We don't do Elliot to show that we were right, to show, that you can identify some crazy pattern. Good job, happy for you. You're probably wrong, but let's make money with it. This is a simple theory. Do not overcomplicate it. And so the whole point of that series is to show you how simple the theory is and how simple it is to apply to the hard right edge, and that you have to do it all. And to be honest, this is one of the things that you kind of have to do as well. It wasn't going to be included in the series because it's a very remedial topic that I expect the members that are into that series to already have down pat. However, I was requested by someone who has, let's say, the credentials that I expect for that series as far as blue belt and things like that. And they told me that this is a topic that they kind of struggle with. And then around the same time, a couple other members that I was doing trade reviews with, or live trade reviews, showed me some analysis that had issues with this. So it's kind of all culminated at the same time that, perhaps this is something that I need to get out there for you guys. And that's one of the struggles as a teacher is, trying to figure out which concepts that, I can't just assume that that things that I think are easy are understood, right? So that's always a battle for me as a teacher. This is one of those things. But I figured I'll go ahead and record this video in the vein of that series, not include it in the series, put it out there in the public. Maybe I'll even list it in the archive with it. And then so you guys can get a taste of what that series is about, and then maybe come over. So, and that whole series is going to dovetail at the very end into exactly like, okay, this pattern, this stop loss, this profit take, things like that. And then again, dovetail into some live trading material that, group trading material for people that have put in the work and gotten to the right belt level and things like that we'll do in the Discord. So enough of my sidebar there. Hopefully you're still with me, but let's talk about degree of trend quickly and briefly. So let me read a quick quote from the book for you guys. So this is from the beginning of the book. I have the most recent, my book is from EWI, so it's online, and it's got the most recent release. And this is in the very beginning of the book, before the first chapter. Until a few years ago, the idea that market movements are self-similarly patterned was highly controversial. But recent scientific discoveries have established that self-similar pattern formation is a fundamental characteristic of complex systems, which include financial markets. Some such systems undergo punctuated growth, that is, periods of alternating with phases of non-growth or decline, building into similar patterns of increasing size. Nature is replete with such fractals. And as we demonstrated in this book 20 years ago, and as Ralph Nelson Elliott revealed some 60 years ago, the stock market is no exception. So basically, that's telling you that the entire theory is based on the idea that the market is fractal. And a fractal is just larger shapes that build into larger shapes of similar type, and larger and larger and larger, like a snowflake, as I'm showing you here. This builds into this, builds into this, builds into this, builds into this, this builds into this, builds into this, and the fractal will then continue on in size forever until, as long as there's trading to put into it, or something to build the fractal, and it will. And if you look at it, you can, in theory, it's divisible infinitely, so that, if this is a 3-wave, then this will be a 3-wave, then this will be a 3-wave, then you have another 3-wave, another 3-wave, another 3-wave, all the way down to infinity. So, and of course your chart won't go down that far, but that's the idea. So that's degree of trend. The market advances in 5s, corrects in 3s. That is your overlying theme of the market. Advances in 5s, corrects in 3s. So let me get my notes up here. Alrighty. So now, one of the couple big problems I find with traders, with Elliott Wave traders on degree of trend, is two things. We'll call it, the first problem is newer traders or lazy traders. I say newer because they're probably a little bit more ignorant of the theory in general, or lazy because they're lazy. They want to trade a move that, the lazy guy, that probably requires a daily chart, but they're on the weekly chart because they don't want to do any work on pattern identification. They see 3 bars and then, hey, this is a triangle. So, okay. Which is, and neither side of this is totally wrong, by the way. Both of these problems, you have to find the happy middle. So that's the number one problem. And what that'll do with those traders is they'll inadvertently sort of mix analysis of degrees, like this wave 4 with this wave 4, or this wave 5 with this wave 4, and you want to not mix the degrees of trends, right? So for instance, you should not look at this 1-2 here and then say it's the 1-2 for this 3-4. I see that shit so much, man, so much. So that's the number one. That's the first problem. I wouldn't say the number one in any rank of any importance that I see is the ignorance or laziness. Now, the way to avoid things like putting this 2 with this 4, we've already kind of, there's many things, and all of them so far have been covered in this Applied Elliott Wave Theory series that will stop you from doing that. They sort of twist your arm so you're not allowed to do that. But if all else fails, you have the right look guideline, right? And, admittedly, if you're not a purple belt or above, you're probably pretty shitty at right look. But this is something that you can always improve on. This is something that, personally, I feel like I'll always be improving on. I'll always be getting better at this theory, and applying it to the hard right edge and making money with it. Because unless I've got a win rate of 100% and nobody does, then there's room for improvement. And that's the kind of attitude you have to if you ever want to improve. If you're the type of trader that, takes a loss and then blames the theory or blames something, blames the market, blames your schedule, I was busy, yada, yada, blames the news, you're fucking doomed. You need to look at every winning trade and every losing trade and grow from it. So, another little sidebar that I didn't mean to go on. Sorry about that. So, in any event, that's the number one problem. So the number two problem, and I see this from a little bit more advanced members that are starting to learn the theory, but they don't really have they might know all the rules and guidelines pretty good. They know all the patterns, and they know that that the market is fractal, and that that if I look inside this B, there's another B. And if I look inside that B, there's another B. And that B, another B, et cetera, et cetera, et cetera. And they kind of get caught up on that, to where if they're trading, they're looking to trade for this C wave, they'll get caught up on, oh man, I don't know, this B wave looks crazy, and they'll get up count this B, and they're like, okay, well, hold on, now I got to count, is that 535 actually 535 within? Man, I don't know if the A of the A of the A of the A has 5 waves, and then boom, they missed their fucking trade, or they convince themselves of something crazy down on this degree, then it goes against them. They lose the forest through the trees kind of thing, right? So what's important for that is you need to know that the only degree of trend that really matters, is your degree of trading. If you're trading for this C wave, You want to be able to see that you got 3 and you got 5, right? 5 and 3, okay, trading for C or 3, right? So the subdivision of this B wave is irrelevant. And certainly the subdivision of the B, right? If you can make out 3 waves, it's good. And there's a reason that, again, the market progresses in 5s, corrects in 3s, that all correctives are called 3s. Triangles are called 3s. Triple combinations are called 3s. But they're not 3-wave, right? But they're called 3s because guess what? You zoom out and it looks, and on the chart, it looks 3-wave. You zoom out, and, a diagonal might look like, it's just a green bar. It's a 1. It's a motive, right? So you kind of need to understand that, you need to keep sight of the forest. Don't lose it within the trees, but you can't be too lazy. It's a sliding scale of importance. So just focus on your degree of trend of trade, right? And I personally, if I'm trading this C, I want to see this B, and I would want to know that, I would want to know that the 1 degree larger to know that, okay, I'm in a 4 and I'm trading for a C. So I'm really counter trend to, the larger degree, but, with the trend at my trading degree, because these are all things that you need to take into account when you're sizing the position and things like that. Because, if you're with the overlying trend, say trading for the, I wouldn't trade a B because that's counter trend, but, trading for the, let's say 3 of the 5, that you're with the large degree. Anyway, that's sort of out of the scope of this video, but we'll definitely get into that more in this Applied Elliott Wave series. So those are the 2 big things that I see. And then one other note that I want to leave you guys with before we drop off on this is that this is from a quote from Ralph Nelson Elliott, but I'm going to paraphrase because I don't write it down. But, I use it all the time because this is more about towards those guys that would go, want to dig all the way into the microscopic level of the chart when they're not trading that. The degree of trend the count is not always clearly evident at all degrees of trend simultaneously. If the lower degree is giving you trouble, zoom out for clarity. If the larger degree is giving you trouble, zoom in for clarity. So to directly relate that to a chart right now, that's, I wanted to do more on charts in this, but, I've been talking a lot as I do. So if we're calling this the larger degree, we're on the 4-hour chart. This has been sideways fuckery for months now. But what I've done to trade this chart is I've zoomed in and I've traded on the lower degree, and I've traded a shit ton of times through here and very profitably. So if I zoom in and I trade for, this leg relative to, all of this, it doesn't matter what's going on here. I might have an idea, but that my degree of trend that I'm trading is all that matters. So I don't necessarily need to worry about a lack of clarity, at the B of the B of the B, when I'm trading for 2 degree higher C, or, the what the count of all of this is if I'm just trading to get maybe a leg up here, right? So that's that. It's a remedial topic, but it is something that you need to understand and be able to apply to the hard right edge. So I hope you guys liked it. And if you're not a member, the series is sort of full of stuff like this, and it's just going to advance further. And again, at the end of it, it's going to be it's going to dovetail into another project for me that is all about trading. Haven't really finalize what I'm going to do with that yet. But, yeah, that's where we're at, boys. Hope you like it. Enjoy. Toot signing out.